And good morning, everybody. How we doing out there? Welcome aboard with the Daily Target 100 live trading room. My name is Doc Severson. Today is Tuesday, the 26th of July. Welcome aboard, everybody. Good to see you out there. All right, I'm going to park myself down in the lower left-hand corner, and away we go. All right, so we saw some news coming out today, and we just got a whole pile of it here. And let's go. I'm going to bring this over live, and let's see what we got in terms of consumer confidence. Here we go. 5, 4, 3, 2, 1. Okay, so consensus was 96.8, and we actually came in a little weak on 95.7. What does this mean? Does this mean that things are slowing down, perhaps? New home sales. As you might expect, these are getting a little bit softer than the craze that has been. So 664 consensus actually came in a little weak at 590. Home sales slowing down. Richmond Fed Manufacturing Index was expected to be, I believe this was negative, and it came in at 0 today. So consensus minus 10 came in at 0 unchanged for that. So not too bad. So kind of a mixed bag in terms of economic reports that came out today. Not necessarily market moving so far. We did have some big earnings coming out. So right now we're sitting at about 75% chance tomorrow that the Fed is going to raise interest rates by 75 basis points. And we're looking somewhere between 2 3/4 and 3% for the September timeframe, but anything could happen during that time. There's almost 2 months away. So this morning we got started with some major earnings on GM and Coke, McDonald's and UBS and UPS. Could walk you through there, but it doesn't really matter that much. A lot of this has to do with what happens tonight with Google, Visa, Microsoft, Chipotle. Public service announcement. It's not Chipotle, okay? It's Chipotle. Chipotle Mexican Grill. Those are coming out this afternoon. And it just begins to be more fun than that. Tomorrow morning we have Boeing, we have Bristol Myers Squibb, we have the Phi Brothers, Shopify and Spotify, and we have Ford and Facebook tomorrow afternoon. And then, of course, tomorrow afternoon we have the Fed. The Fed. So it's funny because like 15 years ago, the Fed used to be huge, right? Coming back into like 06, 07, they kept raising rates every single meeting. And then the big speculation was, when are they going to slow down? When are they going to stop? Are things, weakening too much? And so, of course, they get it wrong. They got it big time wrong. And we all know what happened at that point. And then the Fed just sort of went into the background for several years. So especially after 2010, it was important that they were going into the whole quantitative easing thing. But we got into 2011, 2012, 2013. And yeah, the Fed was kind of in the background in terms of the meetings. Really, the most important thing that would happen was when they would grab a microphone and talk about accommodative policies and 0%, and extending, kicking that can down the road. Was very market positive when they would say that. But the meetings themselves were really very low drama. It's back now. It's back. So we're going to get some big volatility tomorrow. Everybody's expecting a 75 basis point rate hike, but we don't know what the language is going to be around there. Do they know in advance what the GDP number is going to be on Thursday? They probably do. And they might couch their language in terms of that. Now, everybody's expecting a negative GDP. This is already priced into the market. How negative? We'll have to see. And, so anything could happen between now and Thursday afternoon, maybe even Friday morning. All right, we got Bill, we got Keith, Mark, and Dawn in the room so far today. Welcome aboard, folks. Okay, so this week we'll be here Monday through Friday, 11 o'clock Eastern. Next week as well, too. Today, sim trading. We are avoiding risk by avoiding risk. Although I tell you what, these will probably all work out. That's always been my expectation, is when you back away from the obvious risk, that's when the market tends to pay the best. But still, I wouldn't have a good explanation as to why we were to get stopped out on a trade that I took this week. So we're just not going to do it. No live trades until Thursday. So hopefully we'll get a big move by Thursday, and then we can just sort of play along with that. We'll play in that same direction. Okay, so let's get into the charts today, and then we'll get into some trade entries. So today we're a little bit soft today. We're a little bit soft today into the on the S&Ps, and sort of range bound, but starting to weaken a little bit. I want to look at the market internals here and see what they're doing. Still very, very flat. Not a whole lot. Here's a little sell program that just came on board, but still very, very flat for right now. Okay, let me look at something here. And so what we're going to do is we'll do some sim trade entries here in a couple of minutes for 10 wide and 25 wide. And then if you have any questions or if there's anything you want me to go over in the rest of the remainder of the session, please let me know what that might be. And we'll get going with that. Okay, so let's get into the sim entries, shall we? So first of all, we've had a number of positions already closed. So one filled this morning. The call spreads filled this morning. And so if we're looking at, these are the 10 wides. So, excuse me, let me look at the 10 wides here. We entered the 28 on the 22nd. This is Friday. We entered the 28 July positions. And the next day or Monday, we sold out of these, the call spreads. And then yesterday, we sold out of so both the call and the put spreads for the 28s were gone. And those were the positions that we entered on Friday. So the position that we entered on Monday, right here, the puts and the calls. And so you can see that both of these are now gone. Only took a day. We're getting enough movement. And this is the beauty of a strategy like this is that if you get enough movement, you can kind of just go with the waves here and get filled on both sides, not only on the way in, but also on the way out. So we don't have any 10 wides anymore. Now let's look at the 25 wides, 25 wides for the larger accounts. Here are the 28s that we entered on Friday. So we closed down the call spreads on Monday. And let's see, later on Monday, we closed down the put spreads as well too. So those are gone. And then here's the 29 July positions. And this morning we closed out the call spreads for our target, and we're just holding on to the put spreads at this point. So let's go see what they're doing. So the put spreads are still out there, and they're not down all that much at all. They got quite a bit of room. So let's start with the 10 wides and get going with those. So we are going to go out to, let's see, what do we got here? Looks like we'll be doing the 1 August. We'll be trading the 1 August. So that's 1, 2, 3, 4, and then 5 trading days. So we're going to be doing the 1 August spreads today. One quick way to do this, and we do have some other tools coming down the road, but one quick way to do this is just to start by looking at the potential deltas. So like 3 deltas, etc., is a good place to start. Now, what I want to check also is to make sure that I have the call spreads to be able to play this. And these are going to be a little bit tight because looking at the 10 wides, it looks like the closest that I'm able to do 10 wides is 4120, 4130. And that's a 4 delta, which will be close, but we might get a little bit of extra credit from that. So if we get more credit, then we'll put our exit order a little bit higher so we can get out. Again, Our job is to get out as soon as we possibly can with these trades. Okay, so let's start with the calls and then we'll come back and do the puts. But it looks like the 10 wides, that's the closest, or that's the furthest I can go out, is about the 4 delta there. So I'm going to look at selling a vertical, 41.20, and then move this out to 41.30. Okay. I'll be darned. Look at that, midpoint 30 cents. So I actually have to move that back a little bit. That's interesting. A 4 delta will not fill. So I can move this back to 41.10, 41.20, and that will for sure. So I'm a little surprised here. Normally, I'm sorry, wait a minute. What am I thinking here? We're doing 25-cent credit. So 30-cent credit will be just fine. That will be just fine. So we got Larry and Scott joining the room today. Okay, so one contract, 30 cents credit. Let's confirm and send. I'm going to sell one 30-cent credit, $10 wide spread. Let's go ahead and send that off. And there we go. We have been filled. So now let's go down to the put spreads. And let's see if we can find something that we like. I'm going to start here with a 36.80. We're going to sell a vertical. We'll sell the 36.80 put, and then we'll go slightly further out of the money, buy the 36.70. That's showing a 25-cent midpoint. That's probably right on where we want to be. And so let's get this one in place. Sell one vertical, 10 wide, 25 cents. That's our target. And we are filled on both sides. So again, this is a sim trade. So sim trades, if there is another trade, if there's another position that's been filled at those strikes, it will accept my fill. So this differs from live trading. Sometimes you get filled at the midpoint. Sometimes you got to work it a little bit. So I've normally been fine. Like if I go to the spiders are very, very notoriously stingy with getting filled at midpoint. So those can be difficult, but the SPX usually is a pretty good bet to be filled at midpoint, but it's always going to depend on the liquidity of that option pair that you have. So if we look out at our monitor tab, we can see that we have the full iron condor right here for 1 August, which is next Monday. So we're trading next Monday's options. And so the first thing I want to do with these is go ahead and I'm going to highlight this, create a closing order, and we're going to, remember we got filled for a little bit more than this, so we can go for like a 15-cent order. We can go for a 15-cent limit instead of 10-cent limit. And we'll do this good till cancel, 15 cents, confirm and send. Out we go. Okay, so those the calls, and now let's set up our limit order on the puts. Create closing order, and we're going to just buy this one back at a normal price of 10 cents. Limit, good till canceled, confirm and send. Buy one, 10 cents. Always a good idea to verify your orders. Okay, so we're done with that. We're done with our offense, and we're also done with putting in our limit orders for that. So now I'm going to go over to the other account so that we don't intermingle and intermix spreads. And I want to do the same thing here. I want to start out with the calls because these are the hardest to fill. And I want to see if we can get a 41.25, 41.50. So this right off the bat screams out to me that this is the pair that we're going to start with. So 41.25, 41.50. That's 25 wide. And we can get 60 cents of credit. So can we go further out than that? So we can do 41.30. We can try 41.50, 4,200. We'll try that. I don't think that's going to pay enough. $41.50, 42. Oh, be darned. Look at that. 45 cents of credit. Boy, that's amazing. There might be some skew to the upside there. That is a 2 delta. Okay, so let's do it. Let's go for a 45-cent credit. Again, probably wouldn't be filled at 45 cents for this one. Probably be filled at 40 cents. But I'll take it. So we have the call side filled. Now let's go move to complete the iron condor on the put side. And I'm going to start by looking at 50 cent. Did I just do a $50 wide spread? I did, didn't I? Wow. Okay. So what I'm going to do is I made a mistake because I can't count. So I'm going to blow out of this thing. I'm not going to try to Frankenstein this. I'm going to create a closing order. I'm going to buy it right back for 45 cents. And it's gone. All right, so I'm going to, okay. Well, that's strange. Why does it say I still have a position there? All right, so what I'm going to do is, really? Maybe something else just filled. No, this is not. This is still a, I got in and got out of this. So it's still, it shows that I still have a position here, but yeah, thanks guys for catching me on that. That explains why I was able to get such a nice credit on that. It was a 50 wide because my math is, all right, so we're going to go back to the 41.25. And I'm pretty sure that's a $25 wide spread. So we're going to go ahead for the $60 credit or 60-cent credit on one contract. And just go ahead and do that. I'm not sure why this is going on here. I'm not going to worry about it. So if I have a superfluous 41.50 call long, I'll deal with that later. But we did fill the position, so I'm not sure why it's still out there. Okay, let's go down to the puts. Let's see what we can do on the puts. I'm going to start with 36.75. And we're going to sell a vertical there, 36.75, and then 36.50 would be that's 25 wide, and that's a 45-cent credit. I like it. I think that's fine. Could we go slightly further out? Could we go slightly further out? No, we can't because it's missing strikes. So I will go with this with 45-cent credit. Okay, so that's filled. So we can get out of this one at, let's go back to our monitor. We have the 1 August puts, and so let's close this out. We got in for 30 cents. No, I'm sorry. We did not get in for 30 cents. We got in for 50 cents, which is about 10 cents more than we normally get. We're normally looking for 40 down to 10. We're looking for a 30-cent differential. So we can put a 20-cent order in for this one. 20-cent closing order. Now this changes if you do get a gap up in your favor, then you can take the order out and wait till the market opens up and see if you can get something better than 20 cents, maybe 15 or 10, and then increase your profits for that. Okay, so because of the fact that we got in at 50 cents, I'm going to put in a 20-cent debit order. Good till cancel. Let's confirm and send. Buy one, 36.75, 36.50, 20 cents, and off we go. Now let's do the same thing for the call spreads. The call spreads we got in for 41.25, 41.50. That's a 65 cent. Again, we're looking for a 30 cent net differential. So I can put an order in for 35 cents. 35 cents. Now notice that this is kind of screwed up here because it thinks there's a back ratio, but I want to pick the second option here. And it's just a straight vertical, 41.25, 41.50. And we're going to set this for a 35 cent limit, good till cancel. Confirm and send. Off we go. Okay, we're all set. Do you guys have any questions on anything? I'm working on a new chapter in the materials for the course. It's going to be on defense. We're going to do static defense first. Static defense first means that a static defense is something that you set up ahead of time. So in other words, if X gets hit, then I will get out. So static defense could be 50 points away from the short strike. It could be hitting a certain delta. It could be also hitting a certain net debit. So an exit cost could be your exit for these. Mark, can I go over the probabilities of a positive expectation using the Sharpe ratio or any other metric using this method over the long term? I am not familiar with the Sharpe ratio. I've heard it. I have not applied it towards anything that I use. I use two things. I use the win rate and I use the profit factor. So profit factor, so you can use whatever you want to attain whatever measurement that you're looking for. But what I want to know is whether or not my wins are more than my losses. I don't really care that much about the win rate. I can show you a winning rate of 96% that loses money. I can also show you a winning rate of 30% that makes money. So a win rate, and based on the nature of your question, you probably understand that already. But profit factor is really, to me, the bottom line. So I'm going to look for the gross dollar wins divided by the gross dollar losses. And then I want that to be greater than or equal to 1.5. So in other words, what this is showing is for every dollar that you win, so I get a 1.5 for every dollar. For every dollar that I lose, I'm winning $1.50. That's what it means. For every dollar that I lose, I'm making $1.50. And so if you're doing something about a 1.5 profit factor or higher, you're probably running a profitable system. You're probably running a profitable system. So again, you can tune anything the way that you want to. And I've talked about this before. You can run iron condors that are a mile wide, similar to what we do in the room here, what we've started out. You can also run them much tighter than that with a better reward to risk. So you can start to match whatever. So I'm also a believer in running things for very quick, right? So get in, get your fair share, and get out of the trade, which generally involves playing much closer to the money, more of that close quarters battle type of trading. Yeah, so this would be a net of 50 cents, right? So if you lost $1, you made $1.50, you've netted 50 cents on this, or 50. So Scott I tried your butterfly yesterday. It turned out to be a perfectly sideways day and worked beautifully. Yeah, that's a range day. Yesterday was a good range day. Okay, so can you show us how you decide what strike price to start with and more on the use of the opening range? Okay, I can do that. Let's go to my... What I will typically do, Scott, so again, for those of you that missed out on yesterday's discussion, here is the red is the opening range. This is the first 30 minutes of the price action. That's during the day. This is one way to sort of box in the price action, right? So I'm not a big believer in using a lot of technical studies during the day. I don't think it really helps you much unless you're just scalping. You're just looking for little pieces of edge and scalping and things like that. But really what I want to know is this a range day? A range day is where it basically just trades within a range all day long and just doesn't go anywhere. Versus, and so that was like yesterday. Here's yesterday's price action. Here's the opening range. Price really didn't go anywhere at all. It really just kind of stayed, and that makes sense because of all the risks that we had into this week. So I'll use this opening range, and then we'll extend out the opening range. So what happens is with this study, this is my Thinkorswim study, once you move to the next day, this one disappears. So I'll go back and just sort of highlight these from the previous days. Let's see. And I've got one here. This was a range day for a short period of time, up until around the time that we started. So Scott, what I will do is I will let the opening range print out. This is the opening range. I will let that print out. And then I will give it another maybe 15 minutes or so and say, do you really, really, really want to be range bound? And sometimes we get these little moves. These are little, what I call Groundhog Day moves, where it's like we start to trend down and then it comes back up into the range. And so this one stayed range bound for about 45 minutes. And that is about all you need with a trade like that. So I'm typically using like 1,000 tick on the S&P. I like tick charts because it shows me the price action much better. All right, St. Rocco, in other words, your profit target is 20%. 50-cent profit over, well, it depends on what we're doing. Again, I'm not sure if you're talking about these trades or if you're talking about the ones that we're doing, the T100s. Okay, back to Scott. Are we trading the ES or the SPX? I'm trading the SPX, but I will chart this on the ES. I will chart this on the ES. I think that's important because the ES is much more liquid. It's an actual trading underlying instrument, which is extraordinarily heavily traded, right? The S&P futures are probably the number one instrument, maybe next to the bonds, that are traded. So there's a lot of liquidity there. There's a lot of movement. Okay, so the formula that I gave you. All right, so profit factor. So if we say we lose $1, I want to see at least $1.50 in profits for something like that over the aggregate. So maybe this is going to be like 1,500 divided by 1,000. So if I have $1,000 worth of losses, I want to see 1,500 worth of profits on here. So my goal is always going to be to do a 1.5 profit factor. Okay, back to Scott. If you think it's going to be a range day, then what is a good way to make income? I will do a trade that fits a range day. So there's several different ways that we can do this. Okay, sorry guys, I'm kind of running back and forth here between two threads. Let me finish out with Scott and then I'll come back to you, St. Rocco, because I'm not sure what your point is. Okay. Okay, so for this, what you want to do is if you see a range day, because think about this, most of the movement that we're going to get during the day is going to be either in the morning for about maybe the first 45 minutes to hour, and then it's going to be in the afternoon. So they always say, right, amateurs open the market, pros close it. So you care about the closing move. Do I want to be sitting there trading all day long? No, I do not. As I went into yesterday, I think you lose focus after about an hour. I think you're unable to maintain the edge necessary to be able to think through the trades. If you're doing this all day long, eventually what happens is you will mean revert into that lizard brain animal who looks at risk as a bad thing. And unfortunately, what happens is if we trade too long, eventually we're going to be like Sisyphus. We roll the stone up the hill, it rolls back down, and unfortunately rolls back down and goes even lower. So you're starting to dig yourself out of a hole. And then what happens is you start trading not to lose instead of trading to win. When you begin the day with the right frame of mind, you can trade to win, which is necessary. You cannot trade not to lose, because by doing so, you trade with the herd. So what I'm looking for is looking for a little edge. If the market says, hey, I want to be range bound today, so it's on its own, there's no risk, we don't have any risk events that we're worried about or anything like that, and if it shows that it's trading comfortably within the range, which today was until about the time that we started talking here, and then it's starting to move into this is moving into more of especially after yesterday's close, we're starting to get into a trend day here. But we did have range for about the first 90 minutes or so. We had range bound. And that's usually about as long as you need for something like that. So given that, what can you do? So you can play, and I will just play these I will just draw these out. You can do something like an iron butterfly. Right, so an iron butterfly is something like this, where we're looking for the price to be, somewhere within this area. No, it's not happy. Okay, so if we have the price somewhere within this area, then you're going to see some very rapid time decay for this, and you can literally get in and out within usually half an hour, and half an hour will get you somewhere between $75 to $100 per contract on the SPX, with the wings being set at plus and minus one expected move. So I'm setting the wing or the width of this. You don't want it too wide, because too wide gives you too much risk, even though it may be a little quicker. You don't want it too narrow, because it'll be too slow. This is a 0-day trade. This is a 0 day to expiration. You don't want to do a 1 day or 2 day or anything like that, because it'll be wider, but it'll be so slow, there'll be no edge there. Okay, so that's kind of what you're looking for, is something like that. Now, what you could do also is you could do a low probability iron condor, like this. A low probability iron condor, you're going to have deltas of roughly a 30 delta on the short. Approximately a 30 delta on the short. You'll have to tune them in to get the reward to risk that you want on these. Now, if you're playing these further out of the money, oops, what happened there? If you're playing these further out of the money, let's go with this. So these are obviously further out of the money. With the iron butterfly, your short strikes are right at the money. You're literally playing, close quarters combat with this thing. But if you go further out of the money like this with a low probability condor, what are the pros and cons of doing something like that? Opening range, no. Expected move to the next number. So if my expected move is 29, I would go to 30. If my expected move is 32, I will make them 35 wide. Right? I'll just go out to the next multiple of 5. If it's 36, I'll go out to 40 wide. Like so. We may eventually do these trades in here. So I would say don't rush it, but you can sim trade these for right now. Okay, so again, what are the pros and cons of going wider like this with the yellow trade, which is this is what I call a low probability iron condor. It's a 1-to-1. So for a $5 wide spread, you're pulling in $250 of credit and your risk is $250. Think about that for a second. The difference is when you start getting wider, you start slowing down the trade. You start slowing down the trade. You start slowing down the time decay because the maximum extrinsic value is right at the money. The maximum extrinsic value is right at the money. So that's where your fastest time decay is going to occur. So later down the road, are we going to do some butterfly? Yeah, probably. Probably. What I want this to be is, look, I don't want this to get too complicated. I love what Dave has put together. Dave and then the mastermind group has put together a really simple to follow T100, daily T100 trade, which is exactly how I'm doing it, exactly how Dave has started it out, with just a couple of little tweaks on there. Not much though. But down the road, I think most of you understand that the biggest liability to a trade like that is the reward to risk is terrible. So unless you're really good at staying out of trouble, a big trend will run over one of those. And we're not going to roll these out, so we can't do, because we're entering every day. Every day's trade becomes the next rollout. So how do you risk manage these things to the degree that you need to? So you need to win a hell of a lot. And when you do lose, you have to find a way to minimize the losses on these things. So you can do that by actually playing closer to the money, believe it or not. You can do that by playing closer to the money. So in a trade like this, if my risk is 250 and if my reward is 250, my risk reward is much, much better than I can even withstand a full loss on a trade like this, and it's not going to take me out, right? Whereas if you're trading something with a 96% chance of winning, you cannot tolerate a full loss on that trade. You cannot tolerate, because you'll wipe away literally 15 different profitable trades. Right? So this is what you have to do. So everybody needs to kind of find, what mix works for them. So we can do a combination of 5 days to expiration trades, which is what we're doing right now with the T100s. We can also maybe start to mix in, and again, this is not going to be now, this will be somewhere down the road. As we get into more of what I want to see is I want to see a quiet and trending market character. So I'm getting on all kinds of, we're taking all kinds of detours today. Okay, but quiet and trending market character. This is what quiet and trending market character looks like. You rally, you pull back. You rally, you pull back. This almost sawtooth-like waves. This is what I call corrective. This is non-linear price action. This is very, very difficult to trade compared to the quiet and trending. So the downside of this is you have lower volatility, and this is where we may get into things like time spreads, calendar spreads, stuff like that, right? Because those adapt very well to low volatility conditions. Whereas down here, these are kind of, we're playing off the fact the edge right now is that the implied is much larger than the realized, except for maybe this week. So if we ever get back into, and I'm sure we will at some point because these corrective moves don't usually last for much longer, then we will go into a mix of 5-day and maybe even some 0-day. We'll look for the 0-day and we'll be very tactical about it. We're not going to be just slapping these things on every day. All right. Does that make sense? So there's no one trade is better than another. No one expiration is better than another. There's no thing like 5 days is better than 0 days or 0 is better than 5. There's only the best combination for you in your trading situation. So that is our job here. Our job is not necessarily to just flip trades at you, even though that's what we do. You can look over our shoulder and do that. But our job, I think more strategically, our job here is to help you build your lifetime trading plan where you really do find your thing and you get it to the point where, like, man, I just turn the wheel. I'm just turning the wheel every day, and it's so natural. And that's what I want to help you guys do. Okay, have I answered everybody's question, or St. Rocco, do we need to go back and revisit, or? I think we are clear. So we will watch for these trades tomorrow. We'll see. We'll just keep playing them. We'll play these tomorrow, even though we have a Fed meeting coming up. So that would be like, suicide doing that with live traffic. But but we'll get the repetitions in with our strategy. And hopefully I'll quit making mistakes like putting in 50 wides. So, okay, everybody good? Everybody clear? All right, guys. Well, buckle up because tomorrow, things will start to move a lot tonight. Things will start to move a lot starting tonight. And then tomorrow it's going to move even more. And then by Thursday, it's going to move even more, right? So I'm anticipating a big volatility into this Thursday evening. And then maybe by Friday, we'll start to see things settle down a little bit, or just, people stagger back away from the market in disbelief. But we'll see. I'm still looking for, we still have a nice move here. I actually would prefer to see the price go down first to 3,800 to this confluence of support, fill these gaps that are down there, and then literally explode off of there. The biggest movements that you'll see in the market are ones where we pull back first and then create huge amounts of negativity, and then that all gets unwound to the upside. Breakouts from consolidations do not go as far as when we pull back the slingshot and let it go. So I would not be surprised by either movement, whether we break higher or not. But to me, the better move in the short term is actually if we end up dropping by tomorrow evening. If we end up dropping down to 3,800 on the S&Ps, and this is the ES here, dropping down to 3,800 is going to, the negativity is going to go off the charts. And that's what we want. We want everybody to just basically say, all right, that's it. I give up. I can't do this anymore. All right, because all the longs are going to look at this rally and like, I can't believe I fell for this one again. I'm never going to buy another rally again. And they're going to watch the next rally go by without them on board. When nobody is on the next rally, we know that is at least an intermediate bottom. So there we go. All right, everybody, that's all I got. If you have any questions, please reach us through the support email, support@12minutetrading.com. And again, my name is Doc, and I will see you guys tomorrow morning. Everybody be good. Have a good one. Bye now.